Welcome to our today's video, and we are addressing a question by Shiro Wapike. And Shiro says this: Hello, thanks for your video. I just listened to and mentions a name of another channel. 3 things you should know about investing in treasury bonds. That is the title or the thumbnail of that video. He mentioned of inflation in bonds in the long run. I know he is right, but I need clarification and your take on it. Then she goes ahead and adds to our question and says, the interest that is paid to us every 6 months from your suggestion to reinvest into MMF. However, we still get taxed on the MMF again. So it is double taxation from the bond and then the MMF. Why not just leave in an MMF at once and just reinvest over and over for a long time? The fluctuation in interest rates in MMF can be cancelled out by compounding. Help us. And sure, this is what I want to do. I want to help you in demystifying those 3 things. Shiro Wapike has brought about the question of inflation. Then the second one is the question of double taxation, when I advise that the coupons that we are receiving from our investments in bond market, we direct it to MMF, and she poses to say that that will amount to double taxation. So we are looking at inflation, then double taxation. And I did take my time and watched that video from the channel that she mentioned. And from that channel, I also picked these things. From that video, I picked the following. There's also a question of financial freedom with respect to the coupons that we are getting from our invested bonds. And the other thing was an advice or do not consume those coupons, or rather treat them as seeds and reinvest them. Then subsequently, there also came up other 3 points that it is said we don't advise when we are talking about bonds, and we are said not to mention about the fact that bonds or investing in the bond does not allow top-ups, there are no reinvestments, and no liquidation. I think that is all about comparing treasury bills and bonds and money market funds. And we will be looking at those 7 specific items from that information in an attempt to answer what Shiro PK is asking, and also shed more light and give you a grounding on the 7 important things that I mentioned. And this will come after 3 seconds a short break. In the meantime, as usual, thank you for the like to this video. I know you are going to give us a comment, a question, or even tell us what you would want us to do next. And we'll always be coming back to the comment section to dig for those important requests from you, or also give us our comments or feedback to your comments. And for those who are sharing this information to other people, thank you. You are doing the right thing. We want to share financial literacy and intelligence with as many people as possible. And thank you for your subscription if you are new to the channel. And we request also hit the notification button, because that notification button will be prompting you when we upload our next value-packed video. See you after 3 seconds short break. Thank you and welcome back. The first thing I want us to look at is the question of inflation. Inflation, by simple definition, is the change in prices over a given period of time. The word change is relative. It can mean an increase or a decrease. But in finance, we always follow the principle of prudence. And the prudence dictates that we appreciate the negative side, so that when the good things happen, we celebrate. But the negative side is where we need to cushion ourselves against, because that is where the danger is. And therefore, generally, when we are looking at inflation, we look at it as the persistent increase in prices of commodities. So when we are looking at inflation in the sphere of investment, and I'm looking at it from the point of view of redemption of investments in bonds, because the picture that is drawn or what scares many, and a good example now is Shiro PK, is when a projection on the amount invested, a calculation that depicts that when you invest a million shillings today, and probably that FXD goes for 20 years, a projection that the existing inflation rate will reduce that amount to a figure of maybe 700,000 in 20 years. Then Shiro PK or myself, I think that when the time of redemption comes, CBK will give me back 700,000, which is not the true picture. Inflation does not literally eat into the capital that you have invested. Like you put in 100,000, and at the time of your redemption, the maturity of that bond, you receive an amount that is less than the amount that you invested, that is 100,000. No. Inflation is felt in the marketplace. Inflation, you feel it when you go to make purchases from the market. For example, the price of a loaf of bread when I was in high school, we used to buy a loaf of bread for 20 shillings, a quarter going for 5 shillings. Today, the same loaf of bread goes for 70 shillings, 65 shillings. Now that the inflation rates have come down to a 15-year low of 2.7%, has it brought down the price of a loaf of bread today? No. We continue purchasing that loaf at the current prices. Inflation is measured in different baskets and does not reflect in everything that we do. When inflation comes down, doesn't mean that the amount of school fees that we are going to be paying come next year for our children will come down because inflation rates have come down. No. And the same when you invest your money or you invest your capital in a capital protected investment vehicle like a treasury bond. Because of its low risk categorization, it means that the amount that you have put into that investment, if you have invested a million, on redemption date, you get back your million shillings. But you may face a variation in prices of commodities in the market in that future as compared to what you would be buying today. That is very important and fair. But now let's look at the protection, because all these investment vehicles, be it treasury bills and bonds, be it money market funds, the special funds, the Man's IFX fund, the OC fund, those are in the special category. All these investment vehicles have one thing in common, and that is they are inflation protected. Inflation protected meaning that the rate of return that you're supposed to get from this investment vehicle will always be higher than the inflation rate, meaning that your investment or the capital is covered against that increase or change in prices. But how does this happen? The point or the advice on whether you are going to be consuming your coupons or not, because that is where the inflation protection is. The incomes or the returns that you are going to be paid from this investment vehicle covers the inflation amount or the increase, meaning that over time that capital should be increasing. But the use or how that return is paid is what matters. It's what is important to you as an investor. Some investment vehicles will deposit that return into your capital account or the investment account. And a good example is a money market fund. When the returns are calculated and divided, or what we call distributed, they are credited in your investment account where your capital is sitting, and therefore the returned the income or the return and the capital are now again accessible to the fund manager and automatically reinvested. And if you look at bonds, because bonds do not distribute and credit your investment account, the return is paid to an external account, which is now outside the reach of the central bank, who is supposed to be reinvesting. What happens that is when we categorize the investor as an active investor or a dormant investor. For a money market fund, you are not active. Another person is active on your behalf. That is a fund manager. So for the bond market, since the return or the coupon has been paid to you, you are the one who is supposed to reinvest or direct that coupon into another investment vehicle. And in our previous video, we chose as an example to reinvest in a money market fund for this reason. Because a money market fund is a parking point. That is the minimum or the basic entry level into investments. So if that amount that you have received as a coupon is not enough or does not meet the minimum amount that is required to get another investment in the same vehicle, in this case, another bond or another treasury bill, then allow it to park in the money market fund or any other investment vehicle that will be yielding returns as you build up that amount for reinvestment. That basically, and that one now gives you the compounding element, a reinvestment of the returns because of the principle or what we say that money should never be allowed to stay idle. That money should be put in an investment where it is generating. And at all times, what we look at is the rate of return that you're getting. Is it covering the rate of inflation? If the current rate of inflation is 2.7%, any investment that gives you above 2.7%, that is an inflation protected investment vehicle. Because we have other important factors that we shall also look at individual level when we are choosing the investment vehicle or where to invest our money. Then that brings us to the second item to look at, and that is double taxation. Shiro brings out the understanding or the aspect of double taxation by considering that when you are paid a coupon from a bond that attracts a tax, an FXD will attract a withholding tax of 15% normally, but if it has a period of maturity that is more than 10 years, it attracts a 10%. And Shiro believes that or thinks that once you take that coupon and reinvest it back into a money market fund, and a money market fund attracts a withholding tax of 15%, then Shiro concludes that amounts to a double taxation. What is a tax? A tax is a compulsory deduction that is levied to income, any income. And income, we have two types of income. The original income and any incremental income. Those are two different incomes. So the coupon that you are getting from your bond, that is the original income. Then the income or the interest that you'll be generating from the money market fund on investing that coupon, that is additional income. That income is different from the original coupon income that you got from the bond. So these two are different incomes which are attracting different rates of returns. The coupon was taxed at 10% because of the characteristics of the bond. And now it attracts the income that you're generating or the interest that you're generating from the money market fund on investing that coupon. The coupon now does not become an income. It is becomes in the money market fund, it becomes your capital. So that capital now generates an interest from the money market fund, which attracts a different rate of return that is 15% because that is the rate that is applicable from a money market fund investment vehicle. So to be clear is that that does not amount to a double taxation. Double taxation only occurs when the same income is taxed in different geographical locations or jurisdictions. Double taxation will amount if a certain form of income will be taxed in one jurisdiction, maybe a county, and also taxed at the national level. That is a double taxation. Two taxes derived from the same income. That is what will be double taxation. Or the same income be taxed in different geographical location or jurisdiction when you are talking of one country and another country. And that is what brings us what we call bilateral treaties between two countries. The same applies from county to county and a county to national government. So double taxation will not amount when you are commuting an income or a return from one investment vehicle to another investment vehicle, because the two investment vehicles will be giving us two different incomes which attract different rates of taxes. And as you consider also on the principle of investment, the output or the income from one investment, when you are putting it to invest in another investment vehicle or even in the same vehicle, it changes from an income to capital. The same when you look at a money market fund, the daily returns or interest that are paid to you from by the money market fund to your investment account, they form a capital the following day, or that becomes your investment amount the following day. And therefore, what is generated the following day, that is a different income that will attract the incremental amount. It's a different income that will be taxed separately. I hope that one is clear, Shiko. And if it is not, I welcome you. Again, in the comment section, tell me whether that one is clear or you still need more clarification. And now that one will push me now to talk about taxation in particular. The third thing or the third element was financial freedom. Basically, what is financial freedom? Financial freedom is the absence of fear of bills. Absence of fear of what happens to your bills because you are cushioned by your investments. Freedom, that freedom is that element of absence of fear. That fear that grips you when you know there is a bill that is accruing and you don't know how you are going to fund that expense. For example, if you know rent is not paid and already the due date are fallen and you don't know where to get money to pay for that bill, there is that fear. When you have income sources that do not depend on you actively, and that gets rid of that fear, that is what we call freedom, financial freedom. And therefore, financial freedom can be felt early in your investments. Financial freedom is not guaranteed or tied to a particular time in your investment journey. You start enjoying financial freedom from returns of your investment as early as when those returns can settle a specific amount of your bill. So financial freedom cannot be tied to time or cannot be tied to a specific amount. Financial freedom will be changing from time to time depending on your lifestyle, depending on your goals and what you would want to do with your money. When it comes to financial freedom, that absence of fear, it's only guaranteed on the basis of the nature and the characteristic of assets that you have built over time. An employed person enjoys a freedom, some level of freedom that is tied to a salary. But the fact being that the job is permanent, but this employee is not permanent. The employee can be replaced anytime. That would say that that is not guaranteed freedom. Or this freedom can be curtailed at any given time, and that's why we say a salary is just a seed. Investment, in this sense, It's your process that converts your active incomes slowly but gradually to passive incomes. You use your salary. If you are paid at 30,000 and you're able to live within the means of a 30,000 salary, you take time and start converting these 30,000 that you can only get if you are actively involved in your work by selling your time. You convert it gradually, and over time you are able to raise the 30,000 from passive sources, sources that do not depend on you actively. And therefore, that fear of I will not be able to fund my bills if I lose my job, the same fear that makes others intimidate you in your place of work and you cannot voice yourself back because of the fear. If you lose the job, the fear is tied on the bills. But if you convert your active income gradually to passive sources, these fear diminishes over time, because at that time you can actually fight for your position. You can fight back when you get eliminated, because your bills, you are not tied to the job on account of settlement or paying your bills. You are a bit free. You can start doing things a bit free because the fear of losing the job on account of it funding your bills is no longer there. That's how financial freedom works. Elimination of fear. Then the third item, when I tell you the coupons that you're getting from your bond, reroute them to another investment. And I use a money market as an example because that is what is now common and what is easily understood by many of us. A money market fund becomes a very good example. There are other many opportunities or places where you can reinvest. You can reroute that coupon that you're getting into another investment vehicle, Manza, X, Orc Fund. You can route it into the stock market and buy a corporate bond from there. You can route it in the stock market and buy shares from there. So the investment or the opportunity where you can reroute that coupon is not tied to a money market fund alone. But whichever other investment vehicle that you route, the importance of that rerouting is reinvestment. Allow that return or the coupon to continue compounding. Allow it to become a part of your capital for investment, and it start working for you, generating more money, because compounding is the miracle behind your accumulation. But what cushions you against, or what gives you freedom, is not the rate of return. It is the amount that you keep on piling yourself. It is the capital that you build over time. It is the fund that you create by piling, keep on adding the amounts of your investment to a point in time whereby that capital or the amount that you have piled, you don't bother about the rate of return as much. You look at other factors, because at this time when you have a million or 100,000, the 18% return becomes so important to you because there's a small capital amount. But if you had 10 million, it is not the 18% that attracts you to putting your money in that investment vehicle. There are so many other factors that you start looking after, because a 10 million, if you are given a rate of 10%, you're already at a million as a rate of return. But this person who has 100,000, even if you give them 100% return, that is still 100,000. It will take them a lot of time to be able to generate a million as a return. So over time, we keep on accumulating our capital, keep on piling that money. It is not the rate of return that will matter most. It is the amount of capital, the amount of wealth, assets, portfolio that you will have amassed over time that will be very important. And that time you will not even be looking much about the inflation, because inflation is an institution-based calculation or determination, and it has other purposes. It is not designed for your portfolio. It is not designed to be a determining factor of the amounts of returns that you're getting. But if you build a massive capital over time without looking at the inflation, the importance is being able to lead a stress-free life because your assets are able to finance your lifestyle and your aspirations and legacy, notwithstanding any other factor as an inflation. And therefore, the basic element here is compounding. And after you have built a massive accumulation of your funds or your wealth or assets, the compounding element becomes automatic. For example, if you are comfortable living a lifestyle that is funded to a tune of 50,000, that means with an investment of 6 million at a 10% return, that gives you a total of 600,000, which translates to 50,000 every month. That is a comfortable asset accumulation that is able to fund your lifestyle. So out of compounding, or if the capital increases to 7 million, where 7 million would give us 700,000 at the end of the year, and a spread of that amount exceeds what you did, the 50,000. These excesses, they will be remaining in your investment vehicle and accumulating over time, building your capital. So the essence is keep on accumulating your capital over time. Forget about the rate of return. Basically, accumulate your capital. The rate of return becomes secondary. And at the end of the day, you'll be able to achieve that freedom and sustain it depending on the type of assets that you have. There is a common phenomenon or something that characterizes our grandfathers and our parents in most households. They have a huge tracts of land, and those are assets. They have a lot of properties, a commercial building somewhere, a rented property somewhere, but with zero occupancy, with 10% occupancy, 20% occupancy. Meaning that our parents and our grandparents, they are so wealthy because they have assets, but they keep depending on us because they do not have cash flows. So at the end of the day also, we are looking at assets that are generating cash flows, not assets that are able. We are looking at the cash flow at the end of the day. It's what matters. It's not the wealth that you have, but is that wealth generating enough cash flows to sustain your lifestyle, to sustain your aspirations, and your legacy? The other thing that important that we look at is the mentioning that bonds. Somebody says bonds do not allow top-ups. I disagree on this point. Bonds or at the bidding stage, during the selling period of a bond, you can place as many bids as you can, and those are top-ups. Mostly a selling period is given a period of 2 weeks. At the beginning of the selling period, maybe I have 50,000. I can place a bid for 50,000 because that is the minimum amount that you can invest in a bond. Along the week, if I get another 50,000, 100,000, or whatever other amount, I'm able to do another bidding. That is a top-up. I will be able to make as many top-ups during the bidding period as it is possible. The only limitation happens once the auction is over, or once the bidding period is over. You will not be able to place another bond or another bid with regard to that particular bond. So top-ups happen, but they only happen at the bidding stage. After that, you wait for the next bidding, where you can continue bidding for your bond. The same thing that would happen in a money market fund. We are not forced to put a specific amount consistently in the investment vehicle. You invest when you are able to do that. With the commitment that you have chosen for yourself. If you want to be regular in a monthly basis, on a daily basis, bi-weekly, or whatever period that you choose, that is what you. So the top-ups in bond investing, they happen at the bidding stage, where you can bid as many times as you want, and in subsequent auction, because treasury bills are issued on a weekly basis. Treasury bonds are issued on a monthly basis. So I can top up or build my investment in the bond market through the monthly auctions, the weekly auctions, or multiple bidding during the bidding stage. The other important one is reinvestments, and we cannot overemphasize on reinvestment in bond investing. In the primary market, to reinvest, we have automatic reinvestment of your matured securities by flagging your account, activating the flag button. This one is easily understood when you look at the issuance of bonds and treasury bills. We have specific pattern that is governs the issuance of these instruments: treasury bills weekly, bonds on a monthly basis. And if you look at the coupon payment structures, these coupons are paid on a Monday. The redemptions also happen on a Monday. You can look at your prospectus. From the prospectus, look at the specific dates that are given when the coupons will be paid to the investors. Confirm from your calendar, those dates are always on a Monday. And that is the same reason why your bond payments, once you have a successful bid after the auction, the payments close on a Monday to match the coupons and the redemption dates with the bids payment dates for those who are reinvesting. Automatically, if you have flagged your account, the SMS on the amount that you're supposed to pay for the successful bid is always minus the maturing instrument, minus the coupons. So you only top up the difference. And that is reinvestment. The other form of reinvestment is what I say as a DIY. Once the coupons hit your settlement account, reroute those amounts and reinvest them in successive bills, successive bonds, or even in the market funds, money market funds, or any other investment vehicle available. And the last one is liquidation. Liquidation would happen on as a redemption, or if you want to convert your active instrument into money, you have the option of selling it in the secondary market. You also have the option of rediscounting it back to CBK, and you'll have your money back. And very important is that rediscounting to the CBK is even faster to accessing money in most of the money market funds. I'm not fighting the money market funds. Those are entry-level investments that I advocate, because every good investor joining the investment world, the entry point has to be a money market fund. A money market fund can double as a savings account. But in terms of liquidating our instruments, our treasury instruments, we have the easiest route in case of an emergency, that is rediscounting back to central bank, which will pay you back in the same day if you happen to relay that email in the morning. If you send an email to rediscounts@cbk.go.ke in the morning, you are assured by afternoon they will have communicated back the amount that you're supposed to receive, and that amount will be relayed to your settlement account with the CBK. So hopefully have satisfied explaining those 7 important issues raised out of a very important question from Shiro PK. Thank you, Shiro, for your question, and I invite other subscribers. If you have a point or if you have a question, if you have something that you want us to look at or give a clarification on, feel free and give it us in the comment section. We'll always come back and look at it. And you think we have delayed so much in getting your feedback, we have our email in the channel description and a number, a WhatsApp number. You can also prompt us in those 2 channels so that we can come back and look at the specific comments if you think we have delayed to give you an answer. Thank you for watching. If you are new to the channel, don't forget to give us our subscription and hit the notification button.